Jerome Powell and the Fed just crushed interest rates by suggesting that the US would potentially need at least 2 more interest rate hikes to bring inflation under control, basically wiping out any chance that interest rates are going to go down by the end of the year. And those remarks in a speech made to Capitol Hill now have the market pricing in a 74% chance that the Fed is going to increase interest rates by 0.25% in July, with potentially another interest rate hike to follow in the fall. And that has had a significant impact on Canadian mortgage rates, with 5-year bond yields jumping up pretty much instantly, leading to what could be another 0.25% hike in 5-year fixed rates. And that comes on top of what was already a 0.5% increase in the last quarter. And in this video, I'm going to show you exactly what's happening with Canadian bond yields as a result. I'm also going to show you where to find the probabilities for future Fed interest rate hikes, and I'm going to discuss what it means for mortgage strategy for you going forward. Oh, and at the end, I'll also talk a little bit about what the Bank of Canada plans to do. But before we get into it, if you want to thrive financially, this is the place for you. So do me a favor, hit that subscribe button and hit that like button so more people like you can see this video. Oh, and if you want a little bit more information than what I'll be able to cover in this video about how to choose a mortgage, make sure you check out my Mortgage Secrets book, which you can get for free at mortgagesecrets.ca. All you have to do is pay the shipping and handling. Okay, so here's the headline. Federal Reserve Jerome Powell says higher interest rates needed to curb inflation. So let's just assume that you forgot everything that happened in the last 2 years, all the interest rate increases, and you looked at the data as of today. And right now, inflation's still over 4%, and your goal is to bring it back down to 2%. Well, without all of the previous information, which of course is relevant, but let's just say it isn't for a second, if you were a Federal Reserve chair, what would you do? Would you be thinking that maybe you should be increasing interest rates, or would you wait to see how things play out? And the reality here is that the Federal Reserve in the US and the Bank of Canada are looking at the situation. They're going, we're still way above target. And subsequently, they're taking steps to make sure that the efforts made to reduce inflation actually stick. However, this doesn't exactly line up with the public's expectation that interest rates are going to come down by the end of the year. And that's what Jerome Powell and Tiff Macklem are trying to make clear, is that you aren't going to see reduced rates by the end of 2023, and maybe not even through 2024. And these statements alone, without making any changes in interest rates, are having a significant impact on the bond market. I mean, as you can see, the bond market alone in a single day is having a pretty wild ride. And if you go back 5 days to just prior to when these statements were made, and there's almost a 0.15% difference in interest rates. Go back a little bit further to a month ago, and what you can see is that interest rates have come up quite substantially in that very short period of time. And this all has to do with expectations, not necessarily the actual increases to interest rates themselves, but the beliefs of the market of where things are about to go. And with these interest rates going up as much as they are on a 5-year bond yield, which has a 5-year time frame, what this tells us is that the market is expecting that interest rates are going to remain higher for longer. And by the way, the best place to get this data easily is to go to Market Watch and type in Canada 5-year government bond yield, because what this will tell you is where fixed rate mortgages are about to go. As the bond yields increase or decrease, so too do 5-year fixed rates. So expect in the next couple days, you're going to see those 5-year fixed rates jump up again. But what's even more interesting than this is the change in the market sentiment with respect to where interest rates are going. And I'm going to show you the CME group. This is the target rate probability tool, the Fed Watch tool. And what it shows you is the market sentiment with respect to how much interest rates are going to go up at various Fed meetings. And as you can see, as of right now, 74% believe that interest rates in the US are going to come up to 5.25 to 5.5%. And by the end of the year, the expectation by most economists and the market is that we're probably going to see them somewhere in that range of 5.6%. Now, that's not the interesting part. What the interesting part is that over the last week, so this month, sentiment has changed significantly. Just 1 month ago, it was deemed that there was only a 36% probability that interest rates were going to go up at the July meeting. Now it's 74%. And as you can see, there's a 60% probability that interest rates were going to remain the same. So in a 1-month period, this has shifted drastically. And the reason why this has shifted so drastically is purely because there's been a change in the dialogue and a change in the conversation out of the Federal Reserve Board. And even though the Federal Reserve can't directly alter interest rates in Canada, it obviously plays a major role. And any changes that happen in the US obviously have an impact on Canadian interest rates as well. Now, that leads us to the bigger question, for Canadians at least, of what is the Bank of Canada going to do? And it's now expected that the Bank of Canada is going to make one more change to interest rates before capping out at 5%. Now, that being said, this number has been revised a bunch of times over the last couple of years, and what happens in the future is really anybody's guess. The best guess right now is that they're going to cap interest rates with one more rate hike at 5%, But depending on what happens in the economy, depending on what happens with growth, depending on what happens with inflation, this could absolutely be revised once again or multiple times. So you really can't bet on the fact that interest rates are going to go significantly higher right now, and you really can't bet on the fact that they're going to come down. Now, some people are preparing for the worst case scenario where they go up significantly once again. Obviously, if that happens, it would be catastrophic to the economy, but there is some light at the end of the tunnel here. In the United States, for example, they're starting to see jobless claims go up. They're now at 3.7%. They're expecting them to hit 4.5%. However, the one thing we know about jobless claims is quite often once they start running, they keep going. So they could end up being higher than that. And there's also a global aspect to this as well, because what happens in other countries can also play a role in Canada, just like the impact the Bank of Canada had this month on the rest of the world when they increased interest rates by 0.25% unexpectedly, causing bond yields all over the globe to go up. So there's really three things to be watching here: what's going on globally, what's going on in the US, and what's going on locally within Canada. And obviously what's going on locally will have the biggest role to play, but what goes on elsewhere can also play a significant role, as we saw with bond market yields going up and the subsequent increases to 5-year fixed rates that are coming in the next couple of days. So what do you do if you're getting a mortgage? Well, the answer to that is simply act as soon as reasonably possible. This isn't the time to be waiting until you're a month out from renewal or when you're just around the corner from buying a house. You want to be thinking 4 to 6 months ahead. That means getting rate holds locked in so that if interest rates do continue to go up, you're protected. And if you do have a mortgage coming up for renewal, let's say in the next year, it might be worth it to put in an application with a broker to have that mortgage moved and then watch what interest rates do. And if they go up, you switch lenders and go to a lender where you have an approval for a lower rate. And if they stay the same, well, you just roll over your rate holder and see what happens. And if you want help with that, you can always go to mortgage360.ca. Oh, and if you want to know how to profit and benefit from the coming real estate collapse, if it actually comes, make sure you check out this video right here.